Hey guys, Brian Davis here from Spark Rental. I am super pumped to be joined today by Mat Simmons of Sim Capital. Matt, thanks for being on the show.
Thanks for having me on, man. I'm pumped to be here.
Absolutely. So last week we talked about how the phase out of depreciation will affect you as a real estate investor. This week we're talking all about financial freedom, affordable housing, investing in real estate at every level with Mat Simmons. So as you guys join us live, just let us know where you're tuning in from, what your questions are for Matt, and we'll keep the show interactive. So on that note, I'll give your official introduction here. So Mat Simmons is the founder of Sim Capital, which has done over $500 million in transactions since 2014. Currently owns and operates almost 4,000 doors in multifamily housing and affordable housing, 9 different states. So Matt, welcome. Now I always like to rewind the clock when we have a guest and have them explain how they got started in real estate investing in the first place, because a lot of our audience members are just starting out, or they're just in their first couple properties.
Sure.
So I'd love to hear how people got started.
So I initially sold a business back in 2006. And when I sold that business, I basically just took a chunk of my money that I made and rolled it over into starting to invest in my own personal real estate. For me at that time, it was just, single family homes. I did start into affordable housing, primarily, the Section 8 segment of the industry, and just started kind of building my own personal portfolio. That was the first time I got into actual real estate. The crash in 2008 actually helped me acquire even more properties, and I got them for, as we all know, pennies on the dollar, right?
Sure.
Especially because in affordable housing, the markets that I was buying in, you saw a lot of those values drop significantly, right? Cleveland, Detroit, some places in the Midwest and stuff like that. And so it really allowed me to kind of accelerate my growth in my personal portfolio during that time, basically all the way through 2014. And that's when, Sim Capital was founded at that point. So it was really just me taking some of the profits that I had made from my other business and just starting to buy my own real estate, just because I knew it was a good investment. I knew it was something that was a long-term play. Invest into it. I knew I was going to have kids. I wanted something there for my kids in the future. And I wasn't looking to make a ton of money quickly. I was just looking to build something over time.
No, that makes total sense. And I understand that you actually have a fascinating story about how you became financially free, how you reached financial freedom, financial independence in
Yeah.
your mid 30s.
Yeah.
But there were quite a few rocks and pitfalls along the way. So I'd love to hear that story.
So it's quite a story, and I love telling it and everyone asks about it. So I was fairly successful, at least what I thought, in my 20s, leading up to 2010. I had another company that I had started after I sold my previous one while I was just buying my real estate on the side. And in 2010, I got the bright idea when I turned 30 that I wanted to go and do one last professional motocross race. So I used to race professional motocross when I got signed when I was 17, raced professionally until I was 20, retired after a bad accident. But I got the bright idea in my 30s, like, hey, let's go do one last race just so you could say you did it in your 30s, because it's a young person.
Yeah, what could go wrong?
Right, exactly. And so I did. I went out and got my license, and I qualified for the last outdoor national here at Steel City in Western Pennsylvania. And I ended up breaking my back in the first moto.
Oh, wow.
I misjudged something and caused me to have a very bad accident. I actually shattered 3 vertebrae. I broke my pelvis in 2 places on the left side. I compound fractured my right leg. I broke 6 ribs and just a nasty concussion. So I was in ICU for a week. I was on bed rest for 3 months. I was in a wheelchair for almost 4 months. I was on crutches for another few months after that. I mean, it was a year and a half long recovery. I had my business running at the time that all this happened, and I thought I had it set up the way that, a business should be set up. I mean, ideally a business should be able to function without the owner there. The owner should be able to step away, and, processes and people should be in place to keep things going. I guess I didn't have that set up properly. And so I ended up losing my business and going bankrupt because of that. And because I couldn't go into the office, I couldn't be there hands-on. I couldn't be talking with our client base. I couldn't be helping the growth. And so we were losing clients. We were losing billables. Bills weren't being paid. Just kind of that whole snowball effect. And ultimately ended up going bankrupt because of all of it. The only thing that got me and my wife at the time and my daughter through all that was my personal real estate portfolio that I had built and was generating me cash flow every single month. And that's why when I was completely healed up and I was looking at what I was going to do at that point, the real estate just was kind of the no-brainer for me, that it made sense to go all in on that. And that brings us to the foundation or the forming of Sim Capital in 2014.
That's a crazy story. Well, I'm so sorry about your injury, but you look healthy now, and I'm glad to see that.
Yeah, no real long-lasting, lingering effects. I mean, I'm a little bit stiff getting up in the morning, and I have some metal in me. But besides that, I couldn't. It could have been a lot worse. Let's put it that way.
Yeah, absolutely. But I love those sorts of stories where investors, they had a full-time job or a full-time business doing something else. They had a little bit of real estate on the side that they had no plans to really take off as their full-time gig. But then something bad happened. They lost their job. They lost their business. Financial crisis hits, whatever.
Yep.
And the real estate does kind of carry them through. That's why Denny, my co-founder, and I, that's why we're so big on building streams of passive income, and particularly diverse streams of passive income. Because you never know what's going to happen. And the more diverse streams of income you have, the more buffeted you are or buffered you are from a crash in any one source of income that you have. So I love that.
Yeah, you're absolutely right.
Yeah. So tell us about Sim Capital and how you guys got started. What your focus is. Walk us through that.
Yeah, so 2014, the company was founded, and really it was just more of a friends and family type of thing. Like, I had my personal portfolio of real estate. I knew what I was doing. I knew how to grow it. Other people wanted to invest in the real estate. They didn't have the time. They didn't have the knowledge. They didn't have the experience. So we just kind of, created the group for them to be able to do that. And then it kind of started to gain some traction, word of mouth. Started gaining some traction. The SEC implemented some of their changes to allow crowdfunding for real estate and equity involvement in crowdfunding, and ultimately, public marketing with Reg D and 506C to generate outside investors if they're accredited. And so it just kind of grew from that point. We did Fund 1, which was a very small $5 million fund. Fund 2 was double that at $10 million. We now have our 6th fund open that's $100 million institutional capital fund that's going to take us to $1 billion in holdings by 25. And so it's just like this. It was really, like I said earlier, it was a snowball effect to the negative side when I was injured. This has been a snowball effect the opposite direction, just because we've proven ourselves. We have a track record. We have a portfolio that's managing. We've been able to meet or exceed our projections for our investor base, and that helps grow. And so for us initially, when we first started, it was primarily geared towards multifamily, Class B, Class C multifamily. And that was the majority of what our focus was, honestly, all the way through the pandemic in 2020. Interestingly enough, you hit on something earlier about creating multiple, additional streams of revenue, right? And I 100% agree with you. And I even agree with you so much to the point of, you need multiple streams of revenue within the industry that you're in through different asset classes and sectors of the industry, right? And Absolutely. So for me, coming out, as a multifamily operator, 2020 with the pandemic and the rent moratoriums and, it severely affected us as operators. Now, we got through. We didn't miss a single payment to our debt providers. We didn't miss a single payment to our investors. We worked with our tenants to get them through it all. We were able to recoup some of that on the back end through, rental reimbursement from the government programs. But we still, it sucked. It set us back 5 years, let's be honest, as far as our growth goes. And so I was looking at, okay, how can we create a risk hedge coming out of the pandemic for the company that still allowed us to buy and invest in the real estate, but was a different asset class, something that was more of a guarantee, so that if, or I should say when, because we all know if the government gets away with it once, they're going to do it again at some point. When they try another rent moratorium, how can I guarantee that we're going to still have income coming in that isn't going to be severely affected by people just deciding, hey, I'm just not going to pay because, well, I can get away with it, right? And so I kind of went back to my roots with real estate investing with the affordable housing asset class and said, let's create an offering for affordable housing for investors, because it's a different type of asset class. It's a different type of investment for them. It's guaranteed by the government as long as the unit passes inspection and there's a tenant in there. We get paid every single month, regardless of whether there's a pandemic, a recession, a depression, whatever it is.
You're talking Section 8 vouchers.
Yep, Section 8 vouchers. Yep. And so we created that in 2020, well, late 21, early 22, and it really started gaining speed during 22. And investors were loving it because they're like, look, I'm invested in multifamily, I'm invested in self-storage, I'm invested in office buildings or whatever it is. But there was really no one else out there offering any sort of affordable housing investment opportunity, unless they went and did it themselves, or you found a REIT that was specifically focused on that. And so for us, it's just about creating that additional stream of revenue, additional stream of income for us and our investors, like you talked about, that gives us a different type of guarantee, especially during hard times, that you can't get with any sort of multifamily or even any other real estate, to be honest.
So, Denny and I have talked on this show many times about Section 8, the good, the bad, the ugly.
Sure.
I have had not great experiences with Section 8 tenants.
Yep.
I have found that they are much harder on the properties, do more damage to the properties, that, even if they only are responsible for 20% of the rent, 25% of the rent, whatever, they're often still late or still defaults on it. So I'd like to hear the counter side of that. So tell me about what you love about Section 8 housing as an investor.
So let me ask you a couple questions before I actually dive into that. Can you do that?
Sure, fire
because
away.
I have a feeling I know why you've had those problems. So how are you placing tenants? What kind of background, credit checks, eviction checks, criminal history checks were you doing? Were you doing all of them?
Yes. Now I say that I have limited experience with Section 8 tenants. I've only worked with a few of them.
Okay.
One of them I inherited, so I actually didn't do those background checks on that person.
Rule number one, never inherit a Section 8 tenant.
Well, fair enough. More recently, it was a partnership deal. One of the partners in the deal is a property manager and is managing this particular property. He said that he screened this tenant, ran all those background checks, said that he believed that this would be a good tenant. So, but did I personally call their? I did not call their personal references myself. I did not. I only glanced over the reports myself. So
so we'll touch on that here in a minute. My second question is what kind of security deposit was required from this tenant?
I think just 1 month's rent. Yeah, although in a lot of states, they put a cap, 1.5 months rent, maybe 2 months rent, but it's hard to get more than like 1.5 months rent from any tenant. Has been my experience.
Sure. Yeah. So there's a couple ways that we really mitigate that risk. Now, again, you're never going to be able to completely mitigate that risk, whether it's Section 8 or multifamily or any other sort of real estate investment with tenant. But the way that we underwrite our tenants is the exact same way we do with our multifamily. They need to pass a full background check, including criminal history, eviction background check, and we do a credit pull as well on them. And if we wouldn't place that same tenant into one of our multifamily properties, we're not putting them into our Section 8 property. And so it's a lot of, you go through a lot of applications before you find the right tenant. The good thing is there's a lot of applicants out there. There's a lot, the demand from voucher holders far exceeds the number of properties that are available for them. So, we get a dozen to 2 dozen, applicants per property in a lot of our locations because of that. And again, we go through a lot of them because they don't meet the background checks. So, as far as criminal history goes, if there's anything more than anything traffic wise, we don't place them in a unit. If they don't have decent credit, we don't place them in a unit. We won't take anyone with a recent bankruptcy. And if they have any sort of eviction at all on their history, it's an immediate turn down. Go ahead.
Well, so that all makes sense, but so I cut my teeth in Baltimore City,
Yeah.
where so I was in lower end
Right.
neighborhoods, in a very, very working class city.
Yep.
And you say that you wouldn't place anyone, any Section 8 tenant in a property if you wouldn't also put them in like a Class B property. But I mean, in the houses that I was buying, back in the mid 2000s,
Mm-hmm.
I mean, I wouldn't place a tenant anywhere because none of those people would qualify for Class B housing. They all had terrible credit.
Right. Exactly. Yeah. I mean, and so that, again, that's about going, you go through, it's not necessarily about quality when it comes to the applications. It's about quantity. The more applications you get, the better chance you are of finding a good tenant to place, which is also why, we've ventured into some cities to kind of test the markets out. And we found that the demand wasn't nearly enough to be able to meet the way that we underwrite tenants. And so we immediately stopped growing into that city because of that. And because
I was just going to say, yeah. So your point sounds more like a point about the market where I was investing in than necessarily that class of housing.
Yeah, I mean, and it is because, if you look at the markets that we're in, like one of our best markets is Cleveland, Ohio, right? And we it's one of the areas that we have our biggest concentration of Section 8 properties in. But the number, we get, a couple dozen applications for every property that we put up for rent there. And it allows us to really kind of, go through and comb through them and find the right tenant for it. The other thing that we do is that we require them to pay a full month's security deposit up front. Because then they're vested into the property, right? A lot of if they're vested into the property themselves, they're less likely. It doesn't eliminate it, like I said, but they're less likely to ruin it and damage it, and then cause bad living conditions for themselves. And we explain this to them, like, look, if you ruin the property, it's coming out of your security deposit, or what we can repair is going to be covered out of your security deposit. Also, remember that you have to be inspected yearly. And so if you don't pass inspection because you beat the property up, we're not going to go in and repair it for you and put you and keep you in that property as a tenant. We'll go in and repair it, but we're going to place another tenant. And you're going to not only get removed from the property, you could potentially actually be removed from the housing voucher program now, the way that the program goes. And so when you kind of put and I don't want to say put a fear of God into them, but when you put a fear of them losing the opportunity to get assisted housing, they tend to take better care of the properties that they live in.
Yeah, no, it makes sense. And, accountability, right? Just reiterating that they will be held accountable.
Yeah.
Now, in the markets where you're investing, does Section 8 cover 100% of the rent, or?
So that's actually a really good question. We tend to try to place tenants, and this also helps us cut down on having to chase tenants even for $50. We try to place tenants where, and we try to choose tenants where the housing authority will cover 100%, 90% of their monthly rent payment. That way it eliminates that need, So a lot of times we'll look towards, single moms that have a couple kids that have very low income on a monthly basis. And it's counterintuitive to the way that most people place tenants in real estate. I mean, most of the time, like in our multifamily, you want an application to make 3 times, their monthly rent, right? Well, this is completely opposite because you want to guarantee that you're going to get paid every single month. The way to do that is by making sure that the housing authority covers 100%, and if not 100%, as close to that as possible.
That makes perfect sense. Makes perfect sense. And, it harkens back to what you said a few minutes ago about how when you're renting to Section 8 tenants, tenant screening is just astronomically more important. I mean, it's important with
Absolutely.
all rental
It
housing,
is.
but
Yeah. But
especially
specifically with
important with
this
Section 8.
asset class, because let's be honest, we know, and I don't want to classify them or put a stigma to it, but
No,
we know the types of tenants that we're dealing with here. And so if you know that ahead of time, you can eliminate most of these issues that a lot of Section 8 landlords and operators have, because most Section 8 landlords and operators, they might have a couple properties here or there, right? It's nothing that's big to them, and they don't pay attention. They think, oh, okay, they're approved for Section 8. A lot of times, Section 8 landlords don't even do background or credit checks. They just place a tenant that comes into, as an applicant. They also don't collect security deposits a lot of times. Like, we've looked at buying portfolios of, larger portfolios of 20, 30, 40, 50 units to add to our portfolio at a time to make it easier. And we look at the rent rolls, and the landlord collects like $100 security deposit. Well, if you collect a $100 security deposit, where's the tenant tied into being liable for any damages? Because
where's the
it's
accountability?
$100.
Yeah.
Who cares?
Yeah.
You know what I mean? And so, so you go through these rent rolls, and you're like, this is ridiculous. And then on top of that, if they're only collecting $100, the types of tenants you're going to inherit. You're going to inherit ones that absolutely destroy the property. And
Right.
so, going back to what you said, is you inherited a Section 8 tenant. We will not buy a property that has a Section 8 tenant already placed in it unless we can run our own new background check ahead of time. And
rescreen them.
And rescreen them ourselves. Yeah. The other thing that we do that I forgot to mention is we do quarterly walkthroughs on every single property.
That's great.
So we're doing quarterly inspections in every single property that we own to make sure, once again, the tenant knows, hey, you got to take care of this property. And if they know that they're going to have one of our staff members in property management walking through that property on a quarterly basis, they're going to keep it much nicer.
Yeah, no, I'm a huge fan of regular inspections, and it just, with Section 8 tenants, it's even more important.
It's even more important, 100%.
Yeah.
Yeah.
So you said something earlier that caught my interest, and while we were talking about choosing the right markets to invest in for Section 8 housing, you said that Cleveland is one of your best markets.
Mm-hmm.
So how do you choose good markets for affordable housing, Section 8 housing? Because I've had bad experiences in more affordable cities like Baltimore, like Detroit. So how do you choose markets that you think are going to be very promising or profitable for Section 8 housing?
So we do a couple different things when we're looking to grow into new markets. One, we keep our buy box very, very tight. Our buy box is $85,000 to $105,000, 3-bedroom or more, single family home that's move-in ready. We prefer things that have been at least updated recently, but as long as they're in good condition and they're move-in ready, that's kind of what our buy box is. So then what we do is we take that and we look at the published data from the Housing Authority with what fair market rents are in every city, which is just do a Google search if anyone's looking for that information, because it's all publicly available. You can see what the Housing Authority is going to pay on a monthly basis based off of their fair market rent determination. So we look at that and we look at, can we cash flow, can we net cash flow a minimum of $650 per door after all expenses are paid, including mortgage, your principal, your interest, your taxes, your insurance, a little bit of vacancy, a little bit of maintenance, etc. So if all of those three things kind of align, then what we'll do is we'll reach out to the Housing Authority in that market and ask them, what's their timelines like? How quickly are they able to turn around applications? How many staff do they have? How many inspectors do they have? How quickly are they able to get inspections done and then re-inspections done if they're required? And because what's really important to us is being able to buy a property, get the few things fixed that we need to fix on it to pass inspection, which a lot of times is like, GFCI outlets and grounded electrical outlets and, railings on steps 4 or more, things like that. And then get a tenant in there and get inspection done and get approved and cash flowing within 30 days. It's really important that we get all that done in 30 days. A, because of the volume that we're buying, and B, we have investors that we have to answer to, and obviously as quickly as possible. Sorry about that. And so If all of those things align, then what we'll do is we'll kind of test that market out. We'll buy 1 or 2 properties in that new market and see how everything goes. One of the biggest things that we have to do when we're moving into a new market, besides all those things, is we have to find boots on the ground people. We have to find contractors. We have to find maintenance people. We have to find the people that can do the walkthrough, with the housing authority checklist for us, all that stuff. So we kind of work on that before we actually go into the market and start buying properties, so that we have all that lined up. Then we'll start, reaching out to agents, kind of, letting them know what we're looking to do. We're looking to test the market, find a property or two, buy it, and see how the process goes. And if things align, great, we'll continue to buy more. And then we kind of go in heavy and we'll buy, 10, 20, 30 a month in that new market, the first month, second month, third month, and so on. But there's been some markets that we found that just don't work well. Detroit being one of them. And there's a couple problems with Detroit, and the biggest problem with Detroit is their infrastructure on the buildings, on the properties is horrible. So like very, very old plumbing, very, very old sewer lines. So almost every property there has to have a sewer line replaced. You're $6,000, $7,000, $8,000, $9,000 right there. The housing authority takes a while. On top of that, it takes them 45 to 60 days by the time they get a packet, they're able to process it, and then they reach out and they schedule your inspection. You're 60 days before you can start cash flowing. They pay well. They pay 15, I think it's 15 this 2023 is like 15 and change for a 3-bedroom, $1,500 and change for a 3-bedroom. But all of your maintenance costs, because of the age of the underlying infrastructure in Detroit, just eats up your cash flow. So it's not a good market to be in because of that. And so, but unfortunately, you don't know those things until you start testing them out. Obviously, we're building a database as we continue to do this, because there's not a lot of big operators out there like us in affordable housing, mainly because there's just a lot more moving parts to it, right? And so we're building out a database as we do it, so we have something of substance for people to use and lean on down in the future. But for us, a lot of times with these new cities, it's a lot of trial and error to figure it out, because no one's really done it at the scale that we're looking to do it before.
No, it makes perfect sense. And I love how systematized your approach is in evaluating new markets, in experimenting with new markets. And that's the kind of thing that, it's mom and pop investors struggle with that. But as you grow to become an institutional investor, like Sim Capital, you can build out those systems and really refine that narrow box like you talked about, and have the 50-point checklist that you go through in evaluating a new market. And I love it.
So it's a systemized approach for everyone here. I mean, they know what they need to do, and it's just a rinse and repeat type of thing. Even in the markets that we're in heavily, that we grow in and we're continuing to add to, every property, it's the same process, from A to Z, and it's just a rinse and repeat type of thing.
Yeah, I mean, the hard part in many ways is building out that system. And once you have a system that works, then, like you said, you can just rinse and repeat and keep adding properties. And it's a lot easier from that point forward.
Yeah, exactly.
So we included a link here to simcapital.com in the comments. Matt, do you have any parting words of wisdom for the audience before we call this episode complete?
I think most people on here already kind of know that real estate is a good investment. I think one of the biggest things to focus on is in the next, I would say 18 to 24 months, I think we're probably going to see one of the best opportunities that we've seen since 2008 to really grow your real estate holdings, grow your portfolio, take advantage of what's going to be coming. I don't think there's going to be a market crash, and I've been saying that. I've never thought that personally. But I do think there's going to be segments of the industry that are going to allow investors who are willing to kind of put the pedal to the metal when most are kind of pulling off the gas or even putting the brake on, to kind of get that leg up over the competition. And so these are the times where that's what you need to do. When most people are putting the foot on the brake, you need to be doubling down and putting the gas pedal to the floor. So just know that there's going to be a lot of scary headlines out there over the next 18 to 24 months. And just know that's exactly what they are. They're meant to scare people. They're meant to keep you kind of, down in that never-ending cycle that most people are in. Use this time to really get that leg up over everyone else, because there's going to be a lot of opportunities. So as far as advice, that's probably the best that I could give right now with where we all are in the current economic cycle and what we're looking at in the future.
I love that. And yeah, it reminds me of the Warren Buffett quote, be fearful when others are greedy and greedy when others are fearful. And this is something that I hear real estate investors say all the time during a bull market with housing. Like all throughout the 20 teens, everyone's like, oh, well, housing's too expensive. Prices are too inflated. I'm going to wait until prices drop and then I'm going to buy. And then, of course, now that prices are dropping in a lot of markets, and by the way, we put a link in the comments here, everybody, for an interactive map to where you can see which cities have home prices that are dropping. But when they do start dropping, and the headlines start publishing about how everything's going to hell in a handbasket in the real estate market, those same people who said that they were going to go out and buy properties when prices drop now are too scared to do it.
Yeah, exactly. Yeah, they're frozen in fear.
So
and that's how a lot of people are. And look, here's the thing. I mean, the saying, when it comes to real estate, you make your money when you buy the real estate, not when you sell it. And you can buy real estate in any market and make money off it. The problem is that I think a lot of people look at real estate like they want to look at it as a get rich quick type of thing. It is not a get rich quick type of thing. It is a long-term play. It is a generational wealth type of play. So if you want to build that, go into it knowing that, right? Don't go in and start fixing and flipping and thinking that you're going to get rich. Fixing and flipping is just a job. That's all it is.
That's a business model. Yeah, it's not investing. It's a business.
It's a job. Exactly. It's not real estate investing. Because as soon as you sell that property, then you have no income coming in. Build yourself a portfolio that is going to be long-term, that's going to sustain the ups and downs. Because look, the bottom line is real estate will always come back. It will always, even if it drops in some markets, it will always come back and rebound. And that's why it's like, for me, I don't care about the fluctuations over the next 3 to 5 years, because for me, it's a long-term play. It's always going to come back and we're always going to be able to make money off it. And we've cash flowed that whole time anyway, so it doesn't matter.
Right. Exactly. Well, Matt, thank you so much for joining us today. I loved our conversation. We got to dive deep into affordable housing in Section 8, which is something that we don't often get to do on the show. So thank you for joining us. And we'll look forward to having you back soon.
Yeah, my pleasure. Thanks, guys. Appreciate it. Have a great day.
All right, everybody. We'll see you next Tuesday. Have a great week.